What's up? Beechmont Breakdown. We are decoding real estate investing. I'm here today with William Hollis of 24 Capital Group. He's been in the business since 2018. And Mr. Hollis, why don't you kind of give us a little bit of your background and kind of what you're focusing on working on now?
Yeah, absolutely, man. Thanks for having me on. I'm Hollis from Hollis, Queens. Always wanted to be in real estate ever since I was a little kid, like 7 years old, watching my landlord collect all the rent, stuffing the hundreds into his wallet. I was like, oh man, that guy's got it figured out. It took me a while to get started though, just because, living in the Northeast and kind of some limiting beliefs I had in my mind, I didn't think, I could really afford it or something that I'd be able to do. Around 2017, 2018, a buddy of mine took me to a small real estate meetup where they were talking all about wholesaling real estate, and that kind of solved my problem. I saw a way for me to kind of get into the business and get started, so I dove in deep with that. But it really wasn't accomplishing what I wanted in the end, which was to actually, acquire ownership of properties and to, build that passive income. So I started looking at how to do that and partnering with people and larger deals. And, fast forward in 2022, we went from 0 doors to we have 81 in our portfolio through partnerships. So really happy to be here and really excited for, what we got coming on in the future.
That's awesome. I saw on your Instagram a couple weeks ago, you were talking to somebody. And, I came from being an agent and working with investors buying their own stuff and, kind of being involved with that process. And then as I came in, we started getting into some bigger apartment deals. And as I did that, I said, well, I would like to just sell really expensive stuff all the time because I make more money. But then, I only had a couple clients that could buy expensive apartments. And so then I kind of stumbled into this. And when I first stumbled into it, I was like, well, this looks like a pretty good idea. And further and further, I joined the Raise Masters. That's kind of where I got connected with you. Further and further I got into it, the more I realized it's like, actually, this is just much better than owning property on your own. And for a lot of people, I was going back and I was talking to the investors that I worked with before, and they're kind of like, oh, I don't know. They like to have control of their stuff. You had a great quote about, do you want to have control of fixing your car, or do you just want to give it to the mechanic and get it done? It's funny to think about that way, but what are the conversations you have with people, as they're thinking about considering syndication? What kind of things do you bring up to them about, what's the advantage of syndication versus just going out and buying property on your own?
Yeah, great question. So it's interesting because a lot of the people I talk to are, high performing agents, brokers who, like you said, there's, they like selling these larger properties because you get the larger checks. But I always tell people, usually if you have enough money to invest in non-owner occupied real estate, that means you're probably pretty good at something, right? You found a type of job, it's got you busy and it's making you enough money to where you have, depending on your market, $60,000 to $120,000 to put down on your investment property. But the downside to that is, how many units is that going to buy you, right? A 2-unit, a 3-unit, maybe a 4. And the reason I bring it up is not that it's all about how many doors you get, but the more doors you have, the lower your risk is. If you think about it, the number of doors, that's rental income against your debt, right? So if I have a 2-family duplex, that means I have 2 streams of income against my mortgage. If one person moves out, I have 50% of the income against my mortgage. If I have 100 units and 2 people move out, I still have 98% of my income against my mortgage. And so that's some of the stuff I like to talk to people about is, analyzing. Obviously, you're giving up some control with the syndication. Maybe it's in a market that you're not super familiar with, but you can familiarize yourself with these markets. But the upside really is that there's so much less risk investing in real estate this way. it's really not even comparable. When you talk about vacancy risk, DTI, right? Keeping your debt to income ratio super low. Imagine owning $1 million apartment building without signing on the debt. It's an incredible opportunity and tool. So, and then the other side, where I like to talk to real estate professionals, especially, is the tax benefits. I'm sure most real estate professionals, realtors, brokers, property managers, whatever they may be, know about what real estate professional status is. Hopefully they do. If you don't, please ask your CPA about real estate professional status. It's literally the holy grail
Absolutely.
of tax benefits, right? Well, when you invest in larger deals, you get to take advantage of depreciation, cost segregation, bonus depreciation, which are all tools the IRS has literally created to help real estate professionals pay less in taxes, because real estate is a major driver in the economy. So as you're selling, properties as a broker, selling properties as an agent, if you position yourself correctly, you can leverage these tax benefits against those other incomes. Not tax or legal advice. Speak to your CPA.
Yeah, absolutely. Right at the beginning of all of that, you hit on something that I've said before, especially whenever I first started finding syndication and realized, how passively you could invest in real estate is that, if you do have enough money to buy real estate, then likely you are successful in something. And so if you're a business owner, you really should not be investing in real estate, because it's going to take up your time. And it doesn't matter what the return on investment of any real estate deal is, you're going to get a higher return in your business. If you are a dentist, you're going to get a higher return being a dentist. It doesn't mean you shouldn't be investing in real estate for the long-term benefits and the tax benefits and everything. But it's investing in real estate is just not passive at all unless you do it through a syndication. And so those people that, think that you're just going to do better by operating, the numbers just don't support that. I always love to see people's pro formas. It looks a lot different because in a syndication, the underwriting is going to be for the entire length of the deal, 5 to 7 years, and the expenses are all in there. And I see, when people are going to buy single families, it's napkin math. And in my experience, that napkin math never really works out that great unless you have a really long period of time, because that risk, when you go out and let's say you've got $50,000 and you go out and you buy a single family home and you rent it out. Well, at any point in time in the first year, the AC could go out and you could be hit with another $5,000, $7,000 bill. Whereas you don't run into that stuff with syndications. And so what you give up in a little bit of the control, like you said, you're not signing on the debt. You aren't, you're not taking any of the responsibility for doing anything, and you're not going to be responsible for bringing more money in because all the money's raised up front. So it's just obviously it's a much more scalable situation. Just jumping into the syndications.
Yeah, it's so much more scalable, and you hit the nail right on the head. That's what I tell people. You talk to a realtor and you say, okay, well, how much is your time worth, right? Like, okay, you sold this large multifamily or you sold this large commercial property. How much time did it take you? How many hours of work did that take you? And how much income did it bring you? Now let's transpose those same hours into what it's going to take you to be a landlord in this duplex property over the course of this year, right? Mm-hmm. Like you said, the return on investment is not going to be there. If you are successful enough to buy rental property, you probably need to keep doing whatever it is that you're doing. That's going to give you the best ROI for your money. And you can still put that money to work in real estate, but, just through this avenue that we're talking about with syndications and funds. And I think really it's a matter of education too, right? A lot of people, interestingly enough, have never heard of this type of real estate investing. I know probably for us, it's like common language and we think everybody knows about it.
It's surprising. It's surprising what a powerful tool it is that people don't know about. So there's probably, I think that we're about 100 agents in our office now. I'm still a Remax agent now. And so I talk to agents in there about it. And it's, if you come across an excellent deal for a fourplex, Well, you should be wanting to sell that to your clients. You should, if what's it say to your clients if you're keeping all the best deals for yourself and selling them the stuff that you don't want? And so, yes, you should be investing in real estate, but you could be investing in real estate in a way that takes absolutely none of your time. And then what's that going to do whenever all of the local deals that are really good, well, you're bringing all of this stuff directly to your clients and you're just collecting the commissions. So you're making that active income so that you can invest in real estate in a way that it doesn't take your time. And that was, one of the things that I kind of brought up to people is that you should be selling, your clients all of the best deals here locally because that's what they want. A lot of people, I think that, getting into the syndications requires you to kind of be able to think a little bit bigger because the numbers are bigger and you think like, oh, well, I can buy into a $50 million apartment building in Houston. Why would I want to own a little piece of that when I can just own one single family home here? And they think because the numbers are bigger, that it's more risky, but it's like you said, the more doors, the more different lines of revenue you come in there, the less risk there is. And, through the syndications and kind of one of the things that I intend to do through this show is to bring a lot of people who are investing in a lot of different asset classes together, because through syndication is really the only way. And you get to a point, I had clients that were buying stuff with me here in Louisville and got up to having a few $1 million of property here in Louisville. And, their accountants and advisors, rich people advisors are saying, well, why are you're too heavy in Louisville. You need to expand into different markets. You need to do all of this. And, syndication is the only way that you really diversify your portfolio. Because if you are going to be the owner operator of everything, then you're only going to be able to do one thing. You're not going to be able to be great in the industrial space and to have like a really nice boutique senior living facility over here, and you've got an RV park there, and then you own a couple of apartments over here, and you do all of that stuff across several different markets. Like that's not going to happen. But with syndication, I can say I have 200,000 and I want to invest this year. I'm going to put 50 into this. I'm going to put 50 into this. I'm going to put 50 here. I'm going to put 50 here. And I'm spread across asset classes and I am spread into different markets. And the hedge and just the risk, the aversion to risk, whenever you can do that, is superior. And that's why, as I stumbled into this, I realized like this is the way that rich people invest in real estate. They don't go buy. Yeah. I mean, they might buy single family homes, but when they do it, they jump in with some other people and they buy 100. They don't just go buy a house.
Yeah. And you make so many great points, right? Because we talk about risk. There's so many different types of risk. We talk about vacancy risk before. Anybody who invests in anything, you'll always hear that term diversification, right? It's actually a very difficult thing to accomplish in most types of assets, though, because, for example, in the stock market, so many sectors are actually directly correlated. Like when one goes down, they all tend to go down, and when one goes up, they all tend to go up. I think real estate is unique in that it gives you the opportunity to not only diversify in asset classes, so all those things you mentioned, RV parks, industrial, mobile home, multifamily, in the asset classes, you can then diversify location. You can also, through syndication, diversify operator, right? Because operator risk is something that I think a lot of people don't talk about. Number one, if you ask most people, nobody actually wants to be a landlord. Like, it's a thankless job. Cool, you get, cash flow, but like landlording is not usually anybody's hobby, right? But also, you could be bad at it. Not everyone is cut out to be a good landlord. And if you choose to operate yourself, 100% of your operator risk is on you. The mistakes are all your fault. Like that, you are the bottleneck, right? But whereas if you invest in a syndication, you get to diversify operators. So maybe you work with one operator who has this strategy, and this is the types of business plans he likes to execute. And then you invest with another operator, maybe also in the same asset class, but he takes a different approach. He has this business strategy, this type of business plan he likes to execute. And now you are not only diversified in actual property, but you're diversified in operators. So that also decreases the risk of failure, because where one may fail, the other could succeed, or maybe they both succeed, but it's unlikely that you'll end up with two bad operators, depending, of course, in your personal due diligence process. So, yeah, it's a really powerful avenue to diversify and risk, and it's kind of when you start to dig into it, I mean, it's kind of a bit of a no-brainer.
Absolutely. I don't know if you've read Alex Hormozy's $100 million offers. I think most everybody has, but
Oh yeah.
it's the thing that it's so good. It's kind of stupid to say no. It's between when you factor in, the tax benefits and everything, which is something that I think a lot of real estate investors that aren't doing syndications, that are, like you said, they're assuming all of the operator risk on themselves. I think that they know, like, oh yeah, there's tax benefits to real estate. But until you start to get into the bigger deals, you don't fully realize what those will be. And I don't want to go down the real estate professional rabbit hole and how people pay zero taxes, but it's a very real thing that a lot of real estate investors end up paying no taxes because they keep going every single year, purchasing more. And in order to do that and achieve that level of scalability, the only way to get there is through syndications.
That's it. I'll give you an example of how we do this. This is at the property level. At the property level. So we bought a short-term rental, right? I think we paid $680,000 for it. The property generates $135,000, something like that, per year in revenue. In year one, in revenue, in year one, because of cost segregation analysis, depreciation, bonus depreciation, we have a $180,000 tax write-off. Now, if you know anything about how write-offs work and passive losses work, obviously there's not going to be enough income. There's not even enough revenue to use all of that write-off. So what's that going to do? That means we're not going to pay taxes on the cash flow this year. We're not going to pay taxes next year. Probably not going to pay taxes on that revenue the year after that either. Imagine the power of that compounded, especially if you're reinvesting those tax savings. When you really, like you said, a lot of people hear tax benefits in real estate and know, oh yeah, real estate has great tax benefits, but most of the time we're not even taking advantage of them because we're not positioning ourselves or investing in a way to actually take advantage of the true power of the tax benefits of real estate investing. We're not talking about writing off the interest on the loan. Like, that's not what we're talking about. We're talking about literally tens, sometimes hundreds of thousands of dollars in tax savings per year.
Absolutely. It's and the owner operator that's going out and buying their own single family homes, they don't have the opportunity to capitalize on that because the effect isn't as large. For like on a smaller single family, if you're buying, here in Louisville, I think, you can buy something $200,000, let's say. Well, in a single family, first of all, your cost seg doesn't work as well, and you don't get the benefit as like a large multifamily building because less of the property is going to depreciate on a faster schedule typically. And so you don't get as much of a benefit. And most of the single family, you're buying on your own, you're not tapped into all of the different accountants and the people who are specializing in these areas. And so you're not even scratching the surface of what you can do really with the tax benefits.
And I think another point we can touch on with it too is the barrier to entry, right? Because this was something that was difficult for me personally, and really it came down to more of it being a limiting belief. But at the same time, the numbers are the numbers, right? So $200,000 home, right? If you're not doing owner occupied, sidebar, owner occupied real estate investing is also a very, very powerful tool that shouldn't be discounted. But we're talking about non-owner occupied. You're just finding properties and buying them, with whatever type of financing you can get available. Let's say you have to put 20% down, not even 20%, 25%. You have to put 20% down on your $200,000 home. That's $40,000. What's your cash on cash return going to be on that home? I don't know, but I'm going to tell you is probably going to be somewhere in the 8 to 11% range, more than likely, after you actually factor in your maintenance costs and all these other kind of ticky-tack costs that can come up when you invest in small multifamily or single-family properties.
You know, the great thing about when you're underwriting a 200-unit building is that as the numbers get bigger, the averages average better. I guess that for no other better way to say it, you know, because I can say average, but if I have 3 units and I'm only over 2 years, well, the average might not work out. And so the first couple years that I own this property, I might be wildly off with my, original pro forma projections whenever I did my napkin math to see what I could offer on the property. Whereas when you get into the bigger deals, it's a lot more, this is what it is. And I think that sometimes your average investor might sit and look and say, oh, well, look at the cash on cash return I can get when I buy this single family house. Whereas in this syndication, they're only offering, a 7% cash on cash. And it can be a little bit misleading. I think it might deter people from getting into it because they think that they're going to do better over here, but it's just not necessarily the case. When you go back and you've actually operated it for a few years and, your vacancy rate, because someone moved out and it took you 3 months to get in. Well, now my vacancy, I don't have a 90% vacancy rate at that point, and I had to repaint and they tore up the carpet and it's going to take me now 2 years to make that money back, which over a long period of time, and don't get me wrong, a lot of people make a lot of money just by owning their own, personal real estate. The thing I think that gets skewed and like I said, and you said earlier, a lot of people, the barrier for entry into syndications, I think is probably getting lower and lower as we get more technology that makes it more accessible to more people.
Yeah. And that's kind of the point there, right? Like you go the single family route, that barrier to entry has not decreased and will not decrease, right? It's non-owner occupied real estate since the 2008 market cycle. They're not just throwing out low down payment loans to just anybody for rental property anymore. That 20 to 25% for non-owner occupied is what you're going to be looking at. And like you said, that cash on cash return in that small multifamily property can be wiped out with a bad furnace. With a bad winter storm can actually wipe out 2 years of cash flow. I actually at Rates Fest, I talked to somebody who had I think there was maybe like a duplex or something like that. And she had to evict the people. The people left the house in such a damaged state. It took her, I think she said, 3 years to make that money back that she spent to get the house back into operating order just so she could rent it out again, right? So, and she probably had to put 20% down to get into that house.
And I would even argue probably that over the past couple of years, just due to the price increases of real estate itself, and then also all of your maintenance and your repairs, the barrier to entry to invest in real estate on your own probably has gone up. Whereas the barrier for entry into investing in the syndication deals has gone down as we get more access, more technology. It's just becoming easier and easier to get into a syndication deal because, let's say maybe average minimum investment for a lot of syndication deals would be $25,000. Well, it's still $25,000. Whereas I don't know of a house that I would really want to buy around here to be a rental where I only needed 20. If I just had 25,000, then that was good. I'll just go buy that house because 25,000 is going to get you $100,000 house. Maybe then you have no reserve. Then you have no reserve. And so really maybe that it gets you a $80,000 house. So you have a little bit of money put back. And so I think your barrier for entry actually into investing like that is probably higher. And I think it's people have got to be able to there's probably a little bit of ego maybe at play that they should have the control. And that's how I go back. I loved your mechanic, your mechanic analogy there, where it's just like, you don't have control over what the mechanic's doing to the car. You just have him do it so that your car runs. Because what you want is a car that runs, not to change the alternator.
That's what you want.
Like, you need the car to start and run.
That's it. And I can really relate to that because when I tell you, Ryan, I'm a DIY guy, man. I like to go out there and I like to try to remodel my house myself. I want to fix the car myself. I want to do everything myself. I want to cut my own hair. And the fact of the matter is, we're just not, we can't be good at everything, right? We cannot be good at everything. And really what we want is the end result. That's what we're looking for, is the end result. Once we put our egos aside, like you said, and kind of accept that fact, we can really start to analyze apples to apples. What are the numbers? What are the risks? Where am I going to get a truly asymmetric return? Not only return on investment, but return on effort. Like, how much work do I have to put in to find this good deal? Because if I want to make money, I have to find good single family or small properties to invest in, have to find good markets, have to find good tenants. Like, how much effort do I want to put into this, and what's going to be the return on that, versus vetting a few operators who will just bring you the deals and you don't have to go out and look for anything. The deals are going to come find you. If you wave 25 grand in the air and say, hey, I have 25 grand to invest, I guarantee you'll have more deals to look at Absolutely. Than you can ever get there.
And access to really quality stuff. Like you said, do you really want the $100,000 house? Which, the fun story about me is I got into real estate. My very first house cost $10,000. It was in not a great area of town, and it had been vacant, bank owned, for like 3 years. And I went in at the time and I did all the work myself and got it rented out. And the cash flow numbers look insane on something like that, right? But after owning it for a couple years, and I did a couple other, kind of cheaper houses like that. After owning them for a few years, this is where I started to realize, like, wait a second, there's more to these numbers than the initial, like, oh, it's going to rent for this. I paid this for it. This is my return. I started to see that at that point, the $100,000 house is maybe not necessarily something that plays out nearly as well. And so with 25,000, you can get access into just excellent properties that are going to perform very, very well.
Stable also too, right? You're talking about you can invest in Class A assets. So imagine, a new build luxury apartment building, being able to invest in something like that with let's take your same number. Let's say it was you, instead of, you had 40 grand to invest in a rental property. So you were looking at the $200,000 house. $200,000 house is not going to be luxury Class A in any market, right? So whatever risk you want to associate with being in Class C, maybe D, you can calculate that. But imagine being able to take that same amount of money and put it into a stable Class A, B plus asset, where, again, you don't have to worry about any of the management, any of the day-to-day stuff that's just not on you, and any of the debt. That to me, that's $100 million.
This is how you said a minute ago about how you can't be good at everything, and so handing your real estate investments off to other people. And something I learned about through Raise Masters is that fund of fund models. And that, to me, it seemed just exactly what I was looking for, because that's the tool to be able to pull all of our investors. So we have like a community of our investors here. And now, how is the way that I can get these people into different markets? And because, eventually, after people own a couple $1 million of real estate in Louisville, they say, like, well, I want to buy here and I want to buy here. Well, I don't know anything about those markets, And when I joined Raise Masters, I got the Who Not How book in the mail. So I immediately bought the audiobook. I set the paper copy to the side, and I bought the audiobook.
Yeah.
And I listened to it, and it made so much sense, because the only way that we can expand into these other markets and these other asset classes, there's no way that I could learn everything I need to know to operate. I can learn enough to evaluate a deal and say, like, do we want to be in on this one? Do we want to be on this one? But even from a fund manager perspective, when in the fund of funds model, you have to do the same thing. It's about who knows how to do this stuff and connecting with those people, because at that point now we've opened up so much. It's not just I can invest in bigger apartment deals if I syndicate. Now all of a sudden it is I can be all over the country, and I can be in every asset class imaginable. And that as a, as someone, if you're risk averse at all, that's got to be a major, major draw.
Yeah, for sure, for sure. And then I know I talk to a lot of people, at least, and this is again, I'm speaking from my own personal experience here. Another thing, we're kind of trained to be afraid of debt, right? Which buying rental property, you have to incur debt. That's just the only way to do it. You know what I mean? But the beautiful thing about this, as you diversify into these different asset classes and as you're able to actually scale, you're not scaling your debt. You're not scaling your debt. You're not acquiring more debt just because you bought a Class A versus buying, a Class B versus buying a mobile home park. You're not acquiring any more debt in any of these different asset classes that you're looking at when you invest through a syndication. And that really is a wonderful thing. If that's a concern of yours, is acquiring debt in your investment or while investing in real estate, syndication is really a powerful tool because you get all the upside and actually zero debt that to go with it.
Yeah, absolutely. The ability to go and be a part of a, huge project and, have participate in no real downside, and get all of the benefits. Like you said a minute ago, it is the offer that is too good to be true.
Yeah, I mean, and the thing is, I think when you talk about risk, obviously there's risk involved with any investment, right? The risks in syndication are basically the same as it would be is that if you bought a single family house, right? And you were in a position where you had to sell or, for whatever reason, you couldn't get it rented out. Like those things can happen in a syndication, but we're talking about there's so many more steps in between that are being taken to mitigate that risk that it just makes it asymmetric. It makes the return so much greater than the risk. And I think that's the goal with any sort of investment, right? You want your upside potential to be way higher than your downside potential. And that's what we're able to create by creating
Absolutely.
these syndication
And
opportunities for
really,
folks.
if you think about it, your loss is really limited to your investment. And so your risk of loss on your own is higher than in a syndication. Because if I put 25,000 into a syndication, the worst thing that could happen is I don't get 25,000 back and I just lose my entire investment. Whereas if I go and buy a property, and something bad happens, I could potentially lose more than what my original investment was.
Exactly. So much you're completely exposed when you sign on for debt. And not that debt is a bad thing. Debt can be powerful when leveraged correctly. But as you're expanding your portfolio in these smaller deals, you're completely exposed on the debt side, right? Any assets tied, connected to that property, depending on what your structure may be, you're just exposed to, like you said, more money than you put in to the property. You bought it for 25, you put 25,000 in, your exposure is the complete cost of the rest of that loan, right? Versus when you don't sign on debt in a syndication, your exposure is limited. You're literally a limited partner, LP, and you get that limited debt exposure as well.
Absolutely. So, what kind of deals are you looking at right now? What have you got going on?
Yeah, so asset classes that I like are short-term rentals and mobile home parks. I like those two asset classes for cash flow and debt. Again, because I really like to look for opportunities where I can squeeze all the juice out of a lemon. And then you think about debt structuring. Residential debt is the best debt you're going to get, right? When you look at, long-term fixed rate debt, it can be difficult to find that type of thing in the commercial world. Well, when you look at short-term rentals, if you go out and, buy a bunch of them in a fund and you are able to get long-term debt on those properties, but you're able to get more revenue out of it because you're using it as a short-term rental versus, just kind of renting it as a single family house. Now that's again creating that asymmetric return where you're able to generate more revenue than you ordinarily would be able to. And I mean, mobile home parks, we're not talking about 8 Mile Salem's Lot style mobile home parks here. We're talking about kind of nicer B+, B- communities that can just need a little bit of upgrading and are able to generate a lot of cash flow and have a lot of different financing options again, and a lot of different revenue streams that we're able to create from
Do
those
you
parks.
do you try to focus on the parks where it's like lot rent, or do you like to own the trailers too, or maybe a mix of those?
Yeah, so usually I like to look at parks that have a lot of park owned homes because I want to turn them into parks that have no park owned homes.
Okay.
Uh,
All right.
so I see that as an opportunity because whenever you have park owned homes, your expenses are higher, right? We're talking about these are relatively frail structures when you think about
Absolutely.
versus a stick built house. It's pretty easy. They're pretty easy to damage. When you do have turnover, your turnover costs can be a little bit higher because there can be a lot more things to replace. Tenants can damage things in the house. I don't want any of that responsibility, right? I want to take the home from being a park owned home and I want to sell it to the tenant that lives there. And the beauty of that is you're able to create a little bit more sense of community because your tenants are a lot stickier when they own the homes and they have that pride of ownership, right? People are less likely to destroy their own property than they are to destroy somebody else's property. So I look at those as
You
as
tricked me a
areas
little
of
bit.
opportunity.
I was expecting you to say not park owned homes, but when you said you look for them with park owned, and then it's an opportunity. Um, so when you're looking to buy something like that, are parks with a lot of park owned homes trading maybe at higher cap rates, and so you're able to buy that and then hold it for a few years and turn it into a mostly owner owned home? Are you is that a big value in that space, in that market?
Yeah, so that's kind of where the opportunity is because of the financing, right? Banks don't want to finance older model mobile homes. So usually, if you're buying a park, the bank will only finance based on the lot rent. And if you have some newer, like built within the last 2 to 3, 4 years, mobile homes in there, you might be able to get those included in your financing. But because you can't finance it, that kind of gives you some negotiating power with the seller to say, hey, these are the loan products available. You need to trade it to me at a better cap so that we can get the deal done. Because if you can't, you can only sell what's financeable, right? Like that's kind of the name of the game in any trade of property. So again, that gives you a little bit of leverage in negotiation.
Awesome. So do you have specific things you're looking for markets as you're going into, mobile home parks? Certain areas you like to target, or is it just kind of wherever is a good deal?
Yeah, I'm still kind of picking my markets. I have a little bit of deal flow. I mean, that's always the other side of it, right? It's like you can like whatever market you want, but if you can't get any deals there, it doesn't really matter. So I have a little bit of deal flow in Florida and a couple of other markets in the South, but I'm still kind of trying to analyze and see where I want to look at some next properties. Been looking at Arizona a little bit too, some other places in the Midwest as well. So there's a lot of different opportunities in some places. I'm still trying to pick out exactly what I want. I really like to target smaller clusters of parks because a lot of money has come into this industry over the last 5 to 10 years in the mobile home park space. But those guys, they're
Mhm.
looking for big stuff as usual, right? Kind of the same thing in multifamily apartment buildings, like 100, 150 units plus. That's kind of where their buy box is to operate at the scale that they want to operate. And so I try to target some smaller clusters of parks that I can kind of treat as a portfolio so that I can get the economy of scale, but I can also get
Yeah,
those higher
absolutely.
cap rates that
I've
come with the
heard
small parks.
that same logic applied to multifamily, and the fact that if you're trying to buy duplexes and quads, you're competing against a lot of people, because there's a lot of real estate investors and part-time real estate investors that can go buy a duplex or a quad. And then if you're looking at places that are 200 and 300 units, well, now I've got a lot of competition against, big money. And whereas like if you find that
Yeah.
stuff that's right in the middle, a lot of times that's where you've got the least competition and maybe the best deals. So it makes perfect sense that it's in the mobile home park space as well.
Yeah. Yeah. It's interesting because a challenge with that is management, right? So, um, in an apartment building, you may not necessarily need an on-site manager, and there are more companies, more property management companies for apartment buildings. There are not that many property management companies for mobile home parks, and so you often do need an on-site manager, which means you probably have to give up the lot rent you would be collecting on one of your units. So obviously that costs you more in a smaller park than it does in a larger park. And so that's kind of one of the challenges that you face in targeting small parks, which is why it's best if you can try to buy them in a cluster, where you can afford to give away one now because there's so many more units close by that he can also
Awesome.
manage.
Well, I know that we have kind of gone over. Do you have any parting shots, last minute words?
Yeah, I think something I'm really big on is having a growth mindset and overcoming limiting beliefs, which really is the highest barrier to entry to any kind of real estate investing. Whether you want to do owner occupied, whether you want to do small single families, small multifamily syndication, overcoming that mental barrier to say, "Hey, I am allowed to do this." Something I always like to say and encourage everybody on every podcast that I'm able to speak on. I encourage everybody to reach for the stars and
Awesome.
grab the
I
moon.
couldn't agree more. Most of the time people just don't do things because it's easier just to believe that you can't than to say like, well, I'm going to jump in and just do it. So I absolutely love it. Enjoyed talking to you this morning. Let's get together and do some deals together sometime. All right, thank you.
Let's do it, man. Thank you.